and you can also buy shares from the existing owners of the company, or owners of the foreign company abroad. There is no bar under the LRS scheme, because what you can subscribe to, what you can purchase for. Next question. After a few years, can the such company opened by individual resident in India can take up a project in India or make investment in an Indian company, share capital, direct investment? What he says is, you are using an LRS scheme, form an overseas venture, can that company again invest in an FDI compliant project? That is the question. It's a dirty question. See, number one is the background. The facility on LRS is for a bona fide activity abroad for the purpose of making overseas investment. Now, the purpose may be bona fide. We assume that it's bona fide purposes. Then you want to avoid perhaps the Indian taxes on the dividend or the repayment in favor of any Indian party without paying any taxes. That may be the consideration. However, you are making a declaration under LRS and under ODA that you are carrying out such and such activity outside India with the NIC classification, NIC 1987 classification of the activities of the foreign company. If you are playing within that declaration, I believe there is no restriction on such transaction. We are talking about round tripping and etc. There is no bar on round tripping except the forthcoming regulation on GAR, Section 95 to 102 of the Income Tax Act. That GAR may be applicable to you, so because it's an avoidance scheme. Thirdly, you may look at Section 93 of the Income Tax Act, where the provisions are like this. Where any resident Indian transfer any assets outside India for the purpose of enjoyment and control of the assets by any other person in India, then such a transaction has to be taxed in India to the extent of such an enjoyment in India. These schemes were used by many corporates, including HCL Technologies, while making the transfer of the entire shareholding to a Mauritian-based company. It's a reported judgment, turquoise investment. They transferred the shares prior to, this is the 2006 case, there was no DCF guideline for transfer of the Indian company shares, NAV-based valuation, prior to May 2010. They transfer the share at 50 rupees to a Mauritian-based company, and then transfer these shares to third parties at a much higher price. And that Mauritius company was a non-resident. So you transfer the assets to the Mauritius company at 50 rupees, and then transfer these shares to third parties, and advantage was to the Mauritius company, which was controlled by the resident Indian. So this is what is the law on round tripping. If you can get away with Section 93, then there is no restriction, there is no stipulation as to the same person who is transferring should enjoy. A third person can also enjoy with the resident Indian. Control and possession of the enjoyment of that property, maybe in India or outside India. Then Section 93 is triggered. You may go through this Section 93 to come out of this clutches. However, I would like to issue a word of caution that of late, people have formed companies outside India under LRS scheme and parked their unauthorized fund into that companies and wanted to bring back those funds. Be careful. Don't go outside the bona fide activities of the Indian parties. That's the last on this question. Any other question? Anup, welcome to you. These questions are only part of my case study, so don't worry. I'm not encroaching on your territory.
My pleasure.
Thank you.
That much less.
XYZ company, India Private Limited, is a wholly owned subsidiary of ABC Company Limited, Mauritius. It's an Indian company which is owned by a Mauritian company. Company has no business at all since last 2 years. Not mentioned XYZ or ABC, perhaps ABC. It is in phase of initial setup. All the expenses for setup are paid by the parent company in Mauritius. The parent company does not want inflow of funds in the form of expenses paid on behalf of its subsidiary to be blocked as a capital in subsidiary company. It's an FDI question. And the parent company does not want to block this fund in terms of capital or otherwise, and it wants reimbursement. I think reimbursement up to 5% of the expenses done in India, up to $100,000 is a current account transaction. Item number 17, last item. So you can reimburse. There is no difficulty. This is my answer unless latest. Query. Can the Indian subsidiary company show its parent company as creditor for expenses for all expenses paid by the parent company directly? Or the same needs to be shown as capital inflow for the company only? Can it be shown as external commercial borrowing? I think we have covered this case study that it's a current account transaction. You need not consider this a borrowing unless intention is different. Is that sufficient answer to this query? Friends, we have Brain Trustee here now. So I will close this session with the permission of Chair. Just and then right. Thank you very much for participating.
Thank you, President. I think we have attended many conferences and quite many of you would have attended, but let me be candid and honest that the kind of session what we had with a just brilliant exposition of MEMA. It was an open heart surgery of Foreign Exchange Management Act. That is suffice to say that many bypasses have been shown up and